Thank you, Mr. Chairman. In the last decade, we've seen financial technology companies, fintechs, driving amazing new innovations in financial markets. Fintechs have had remarkable success in developing technology-oriented solutions to meet consumers' needs. As many banks have exited the personal loan market, fintechs have filled the gap, and today they issue nearly 40% of all the unsecured personal loans in America. In recent years, both nationally chartered and state chartered banks and credit unions have begun to partner with fintechs to offer improved products and reach more customers. This is particularly beneficial for community banks who often lack the resources to develop banking technology. In fact, 65% of community banks consider fintech partnerships important to their business strategy. And these partnerships also generate significant consumer benefits. Bank fintech partnerships generate efficiencies that can lower the price of financial products, expand consumer choice, and increase competition. And these bank fintech partnerships offer a wide variety of credit products, not just small dollar loans, but credit cards, home equity lines of credit, personal loans, auto lines, mortgages, and small business loans as well. Unfortunately, recent court rulings have applied differing legal tests to determine which partner in these relationships is the true lender who is legally responsible for the loans. And these tests have created uncertainty that threaten to reduce the access to credit for customers, especially for riskier borrowers. That's why there's been bipartisan congressional support and industry support for clarifying the issue. So last year, the OCC issued its true lender rule to provide the much needed regulatory clarity. And the rule holds that a national bank responsible, it holds a national bank responsible for a loan when, at the time the loan is originated, the bank is either named in the loan agreement or it funds the loan. This allows the OCC to supervise these loans and ensure that the bank's not evading the law, including consumer protection laws. Now, contrary to some claims, the rule is not intended to facilitate rent-a-charter arrangements where banks don't comply with the law. In fact, the OCC's rule does just the opposite. A rent-a-charter arrangement means that no party takes compliance responsibility for a loan. That's where the true lender rule comes in and is different. It ensures that the national banks that partner with third parties are accountable for the loans they issue through these partnerships, and it allows the OCC to supervise the origination of these loans. You don't have to take my word for it. The current acting director of the OCC, not a political appointee, but one who's been a career civil servant for more than 30 years, recently wrote to Congress making this very point. The true lender rule also provides the clarity needed for bank fintech partnerships to flourish and for national credit markets to function. For over 4 decades, federal law has allowed both nationally chartered and state chartered banks to export the state law governing interest rates from their home state where they are based. The true lender rule simply allows fintechs to partner with banks which already operate with these efficiencies. Absent the true lender rule, uncertainty about who the true lender really is creates uncertainty about whether the bank can export its interest rate. If the bank guesses wrong, the loan could be unenforceable. That uncertainty jeopardizes the viability of the bank fintech partnerships. But more importantly, it disrupts the functioning of the secondary market for credit. Why does the secondary market matter? Because when a bank sells a loan, it frees up capital to make another loan. This is very well understood in the mortgage space. When a bank sells a mortgage to the GSEs, it frees up the capital to lend to an additional home buyer. Well, the same principle applies in the secondary market here. Banks will likely issue far fewer loans if they cannot reliably sell those loans into the secondary market. Fewer loans means less access to credit, less access means higher costs, and less willingness to provide the limited supply of credit to higher risk borrowers. The result? The most marginalized consumers are hit the hardest. This isn't just my opinion. Almost 50 leading financial economists from prominent universities, including Harvard, Stanford, the University of Pennsylvania, made these very points in an amicus brief in support of the OCC's true lender rule. We have empirical evidence too. Studies have shown that after a 2015 court ruling created uncertainty around the ability to export interest rates to New York, it became significantly harder to get loans in New York, especially for high-risk borrowers. Despite the importance of the true lender rule, some I know want to rescind it using the Congressional Review Act. And I suspect the motivation is that overturning the rule would subject more loans to state interest rate caps. But that may not be the effect. I think the more likely effect is that these loans simply won't get made. That's why price controls are not the answer. They'll exclude people from the banking system, they'll restrict the credit supply, and make it harder for low income consumers to access credit that they need. The best form of consumer protection is a robust, competitive market. Preserving regulatory certainty and clarity through the true lender rule advances that cause. Thank you, Mr. Chairman.